Anand Shah joins us now. Let's connect with him. Let's talk markets and what he makes of the current market setup. Anand, good morning. Thank you for joining us. Anand, the strength in the market is mesmerizing. I mean, there's a long list where market should go down, and hardly few pointers left where market should go up. But markets are focusing on those few pointers, not the long list where it should come down.
Hi, very good morning. Great to be here. So this has been the story for practically last 3 years. We have been living in a very tough macro environment, be it COVID wave 1, COVID wave 2, and more recently Russia-Ukraine-led inflationary environment where the energy price and everything went up. So macros have not been easier for last 3 years, but when you see bottom up and when you see earnings trajectory generally for the index, but also broader market, that's been very, very strong. Small caps and mid caps have been outperforming. And within that, the earnings growth is also very, very much stronger than what we are seeing in large caps. Also, that's also reflecting more of a micro and a domestic story, whereas the macro remains tough. So to that extent, market's been not actually very euphoric. It's just chasing earnings. It's just chasing the reality that the corporates India, and especially within that, the segment which has been doing very badly for a decade, which is manufacturing and manufacturing related businesses, the B2B businesses have been doing very strongly.
So where are you investing in this market? I mean, where are you picking your spots?
So again, banking, while it's been very soft, large cap banking, we have been seeing a lot of FI selling within that segment. So despite of fundamentals remaining strong, earnings also coming off fairly strong, the stocks have been subdued. To that extent, the valuations have become very attractive. So banking remains the top pick among the many sectors, but outside that, there are many segments within metals in manufacturing, auto ancillaries in manufacturing, industrial cap goods, which are on the manufacturing alike. These are the areas where we've been sort of positive. Outside that, there are many bottom-up ideas in sectors which have been stressed for a while, telecom being one, airlines being another, hotels. This is again the sector which almost for a decade and a half didn't make reasonable money. And to that extent, the supply is limited, both in airline, in telecom. Obviously, I don't see new players entering in that area, nor in hotels, much supply is coming through. So it's a decent environment to be in that segment.
Anand, hi, this is Anish also joining in the conversation. I was just looking at your contra strategy in the PMS, and your weights for financial services is 33%, manufacturing is 32%, manufacturing allied is 21%. None of these really seem like a contra strategy to me right now, because all of these names are something which people are quite bullish about on a consensus basis. I would believe IT or even other names might be a bit of a contra strategy, but what how do you define financial services and manufacturing as a contra theme then?
Indeed, I mean, this is a stocks we picked up in our portfolios 3 years back, and definitely they were not in flavor at that point of time. But even when I look at today, and when I look at the risk reward in these select stocks that we've been owning in this, they still remain fairly attractive. I think the way we define contra is the stocks where actually the implied growth is much lower than what we believe would be the growth in times to come. And in that context, the select stocks that we own today still remains fairly favorable from a risk reward perspective. I spoke about banking a while back, that the earnings trajectory remains strong. Balance sheets have been very strong. Asset side performance has been fairly resilient. And despite of that, the stocks have been sort of subdued.
Okay, fair enough. That's the view coming in on that contra strategy. What about the outlook on the power space, energy space, etc.? How have you looked at the kind of announcements that we've seen on this front, steps taken by the government, how the stocks as well have fared?
Indeed, I think if for any country to do well, energy is of paramount importance, as Indian economy remains strong, and that reflects in the power demand growth. Again, as I spoke about hotel, airlines, I think this is another sector where I would want to believe there has been underinvestment for a while. We were at one point of time adding thermal capacity very, very strongly, and then we at some point of time reached the power surplus stage. And since then, there has been not many new, especially the coal-based power plants coming through. So we are reaching a point where we are now in a little bit of a deficit, and this deficit will only widen if the economy continues to do strong. So I think this is one sector again which comes within the manufacturing allied businesses. The utilities, we have been fairly positive on this sector, and even the allied sectors like cap goods, which provide new power plant capacities both in thermal as well as in renewables, they also remain attractive for us.
My point is that why banks are not doing well, and while we may talk about it as contra or maybe FIs selling, the bottom line here is that everybody likes bank. I'm yet to find a bear on HDFC Bank. I'm yet to find a strategy report which says, bank should be underweight. So isn't this a consensus view where markets are already pricing in 2-3 years ahead?
Indeed, Nikunj, that's the beauty of the markets. If it's anything is a consensus, it's a lot of things is priced in. Here, I think the other thing that is happening is if you go back into the history and if you see the ownership pattern of foreign institutional investors, there is a significant ownership in financial stocks and IT stocks. And one consistent trade that you're seeing for last at least 2 to 3 years have been that with the rising interest rates in US, there has been a consistent net FI sales happening, bearing few months here and there. And at the other end, you have a consistent domestic buying through SIPs and lump sum inflows that the mutual fund and the insurance are getting. So this is one consistent trade. Now there, if you see, the ownership patterns play a role where the selling largely is happening in large cap banks, large cap IT companies. And when you're seeing the domestic buying, it's happening in banks and IT companies, but it's happening much in the broader market. Even the research depth that exists in the domestic institutions is much deeper. So we actually can go down and see where is the value in mid caps and small caps. So I think this is one technical reason why I would want to believe the banks are sort of, they've been doing well, but they've been relative underperformer vis-a-vis the mid and small caps.
Airlines, telecom, hotels, now these are typical high capex businesses, right? I mean, it's like saying that 2 years they do well, 3 years they do badly. Is there really merit in owning them now, because A, run-up has been strong, and B, soon they will come to the market, whether debt or equity or both, they will have to need capital to grow?
Here's an excellent question. I think this is, it's been last capex cycle we have seen, and the last time when this many capex intensive businesses did well was way back in 2007 or 2008. And since then, it's been a tough time for them. I think there is a merit. The country would need both the asset-light businesses as well as asset-heavy businesses. The question being, would the high capex industries make return on capital invested, or the ROC and the ROEs, which are better than the cost of capital? That was not the case for last 10 to 12 years. We had GFC-led slowdown, and subsequently China continued to export deflation to the world. So we didn't have pricing power in many of these manufactured goods. And to that extent, the return on capital employed was very little. On top of it, they had done greenfield capex. There were some delays there that led to high debt on the balance sheet. So both was not working in your favor. The stocks did very bad. I think the last 3 years have been testament that these businesses have now generating good cash flows. They've improved. I don't think they are at anywhere near the peak return on equity, but they have improved their return on equity. Most importantly, the capital allocation. Every company that we meet is extremely conscious of when we would do capex and how much capex, whether we'll do only brownfield. So they're thinking a lot more today about return on equity and capital allocation. And that's, again, is a very positive news. If you see, we've been talking about India needs capex, India needs new capacities, but it's not coming through. The businesses are fairly cautious about putting up new capex, and that's a good news for the shareholders in general.
Anand, on the overall liquidity situation, how are you looking at the fact that the FIIs may be on the fence or have taken a back seat, and it seems to be the domestic flows which are keeping the markets afloat? Is that a trend that's here to stay?
So I think domestic investors are not going away anywhere. I think SIP has been a extremely good vehicle for retail investors. The volatility in market, which generally shakes the confidence of retail investors, SIP is exactly the right medicine for that. I think to that extent, that inflow remains strong. I think a lot will depend on where is the US inflation number and what is happening on the Fed side, whether we have seen the peak of interest rates, or we are going to see much higher interest rates, or at least the higher interest rates for longer from here. That would decide what's happening on the FI flows. I think the impact of higher interest rates also is reflecting, if you see in the markets, in terms of how selectively value-oriented stocks, the stocks which have more cash flows today, are relatively doing better than the growth-oriented or the tech-oriented businesses where the cash flows are a few years later. I think that's also one reflection how the value trade is doing better than the growth trade in the markets.
On that note, we let you go. Appreciate you making time and speaking with ET now.